Happy holidays, everyone. The holiday season is finally upon us and for the entire stock market, and we're so excited for what's to come. Now, this specific technical analysis video this short trading week is slightly different because it is not accompanied by this week's CFO Swinger Watch report. So before you guys get too upset or sad, I'm going to be doing something slightly different by focusing only on the broader markets and the specific trends that I am personally starting to see that will most likely be relevant into the end of this fiscal year and into early next year. So with that, let's begin with the markets. So all of last week was basically just a consolidation of the previous week's price action, and ultimately we ended up closing back over my daily 10 SMA and also holding up over my daily 21 SMA. So again, my daily 10 is my red line and my daily 21 is my light blue line. And so for most, from Monday to about Wednesday here, we basically moved sideways, consolidating the larger downside move that we had in the previous week. And then for Thursday and Friday, we ended up retesting, reclaiming, and then closing over the daily 10 SMA. Now, there are two things that are kind of concerning here. First of all, whenever we see a reclaiming of the daily 10 SMA, we tend to see a larger reaction once we do close over the daily 10 SMA. And on Thursday and Friday, we basically didn't get that since last Friday's candlestick was a pretty low range, right? We didn't see a wide price range from open to close, or even from the lows to highs of that day. And also, we may or may not be seeing a potential lower highs and lower lows situation. But fortunately, we have yet to see a lower low situation, because if you go on the weekly time frame, what we ended up doing was having an inside weekly candlestick. And so from a textbook standpoint, an inside weekly candlestick usually indicates that there will be a continuation of the current underlying price trend. And what is the current underlying price trend? Well, it's a textbook uptrend, right? We have higher highs and higher lows. Now, before I delve into the possible continuation of this uptrend for this short trading week, I want to take a step back and take a look at the previous week's candlestick right over here, so 2 weeks ago. And this week was when we had the monthly November OPEX. And so on this monthly November OPEX, we saw a lot of weakness on the day of and leading into this specific expiration day. Now on this specific week as well, we hit a new all-time high price target of $600.17, and at the same time we hit that outrageous price target of $600. And once we hit this new all-time high price print of $600.17, we immediately began to move back to the downside, and the price began to reject at this whole number level of $600. And during the time that we began to pull back, we also saw the euphoric emotions that began post-presidential elections fizzle out, which ultimately ended up helping the overall price action into the November monthly OPEX. And so on the Friday of 2 weeks ago, we had a nice gap down and we ended up closing, okay, if you go back in the daily time frame, right on top of the daily 21 SMA and right below the daily 10 SMA. Now, this is important because from a seasonality perspective, okay, the average seasonal trends, we tend to see, as provided here from Goldman Sachs, weakness heading into the November monthly OPEX. And once we go past this specific expiration day, we tend to see an immediate curl back up higher, and we start to hit new all-time highs, or at the very least, new higher highs and higher lows as we head into the end of this year. In fact, we most likely begin the Santa Claus rally into the end of this year after this weakness from the monthly November OPEX. And so this chart is eerily similar to what we're seeing now, as last week we basically held up the lows of the monthly OPEX weekly's lows, and we began to curl back up higher. Okay, there's a lot of similarities with the seasonal composite chart and last week's price action. And so with that in mind, okay, let's go back to what can occur this week. So expanding on that seasonality trend, we are most likely going to, well, at least we should expect to see a retest of this whole number level of $600 on the S&P 500 ETF. And there is a slight possibility that we could be seeing a potential, okay, I'm just seeing a potential double top. Why do I say that? Well, since last week, starting from Wednesday of last week, we began to see a decline of the overall daily volume. And due to this decline on the daily volume here, we saw the overall average daily volume starting to tick down. Now, you may not be able to see it, but the average volume line here, this orange line, is starting to slowly descend back down. And that is due to the very simple fact that we are heading into the holiday season, and we're going to be seeing less participants in the overall markets. And so if we do see a retest of the $600 whole number level, we may not see an overall big push over this whole number level and into a new all-time high price print. And that is where we need to be cautiously bullish, because the fact that we have less people in the overall market. Now, from the more optimistic and bullish perspective, even if we do have low volume, okay, we have the seasonal trends on our side, on our bullish side and bias, because we might see a low volume melt up. And we tend to see that during this time of the year, where we see less participants, but we start to see a lot more bullishness in the overall price action alone. And we may start to see constant new all-time high price prints back to back, right? So this week, all we need to watch out for is a potential double top that could occur due to the low volume. But at the same time, we need to also watch out for the fact that we might see a peak over this $600 whole number level and a possible overtaking of the price from the current all-time high price print of $600.17. All right. So that is it for the S&P 500. Let's take a look at the small caps, or the Russell 2000 ETF, or ticker symbol IWM. Now, there is a clear divergence of relative strength and just overall price action, because IWM has performed a lot better compared to the S&P 500. Visually, you can tell that, right? We have wider and larger price ranges all of last week, and we are more vertical on the price trend as well. And it seems like for IWM, we're about to see a potential V-shaped recovery after that very, very sharp pullback to the downside, which ultimately gave us a much needed retest of my previous price target of $226.50. In fact, on Tuesday of last week, our low of the day on that day was $226.40. So literally a 10-cent difference difference from this $226.50 whole number level. And we were able to hold that level to a T, and we had an immediate reaction to the upside as the price reacted and stayed over my daily 21 SMA and ultimately ended up closing way further out from the daily 10 SMA. And this is what I mean when I said that we usually get an explosive reaction on the daily 10 SMA once we do reclaim it and close over it, but that is not what we saw last week on the S&P 500 or ticker symbol SPY, right? But luckily, we're able to see that textbook reaction out of the daily 10 SMA on IWM. Now, what does this mean as we head into the end of this year and possibly into next year? Well, first of all, IWM for this entire year, right? We have been moving up higher in anticipation, right? In anticipation for more rate cuts. And in September, we got our first rate cut, and in November, we also had a second rate cut. And so for now, IWM is most likely moving to the upside in anticipation for the last rate cut of this year in December. Now, there are a lot of people who are thinking that IWM could most likely hit new all-time highs and maybe even possibly into the whole number level of $300. Now that is kind of outrageous, right? Because I don't think that we can hit $300 by the end of this year. Maybe by the end of next year, could that be a possible price target for IWM, but definitely not for this year, right? By the end of this year, that wouldn't make any sense, right? And so for me, for IWM, from more of a practical and idealistic standpoint, I would say IWM has a lot more room to hit 250 by the end of this year rather than moving another 50 points to hit $300. Right, so this 250, it seems a bit more realistic and also idealistic, and also a lot more practical to think about when we're looking at a very nice uptrend so far, and for the potential moves that we can see on all the underlying small cap names that we're seeing, right? So for all of last week, we saw major relative strength in a lot of individual small cap names and even in mid cap names as well, which also helped with the fact that the IWM was continuously moving back up higher. And so for this upcoming week, IWM can also see a potential double top. And where can that double top be? Well, right at this 242.50 level, or the previous pivot high point that we saw at 242.39. And so I expect the price to at least hit a new higher high around 242.50 and then see an immediate rejection back to the downside. Now, here's the thing. When we're regarding the relationship to small caps and to the overall leaders in the S&P 500, there is a slight divergence, right? Obviously from last week's price action from the IWM and last week's price action from the S&P 500. And so if we do see a double top occurring on the IWM here, there is a chance that we can see the overall strength coming right back into the S&P 500, which can in return see that low volume melt up in the overall S&P 500 that I mentioned a couple minutes earlier. All right, and so for IWM, I'm going to be seeing that potential divergence continuously playing out if we do see that retest of 242.50, which is also a higher high on IWM, and then immediate rejection back to the downside and possibly seeing a pivot around 236. And in the meantime, we might see the S&P 500 rocketing higher on low volume as we see that low volume melt up into new all-time highs and finally above $600. All right. So with that, let's get into bonds. All right. Specifically, I want to take a look at TIP. So this is the iShares Tips Bond ETF. And for all the CFO Swinger Watch report readers that are currently watching this now, you guys should know what this TIP ticker is, because I really expanded on the topic of inflation 2 weeks ago. And I really recommend you guys, and highly recommend you guys, to read the 2 weeks ago CFO Swinger Watch report, because I want you guys to be reminded why this specific TIPS bond ETF can be very important as you head into next fiscal year of 2025, right? So first of all, from a technical perspective, TIP is looking very good. Why? Because it's holding above the daily 200 SMA, and it continues to tighten up right above the daily 200 SMA. And so there is a slight possibility that we can be seeing yet another dip below the daily 200 SMA, just because of the fact that we're so close to it in proximity, and for the fact that the daily 10 and the daily 21 SMAs continue to be a very significant area of SMA resistance. But to be more optimistic, and the fact that we may see a resurgence of inflation, and again, I gave you guys the reasons why we could be seeing that in the CFO Swinger Watch report from 2 weeks ago. So make sure you guys read that first, okay? And make sure you guys remember what I've said and told you guys from that masterclass of inflation in the report, okay? So tip here can see a big pop to the upside if we do see another similar pop in inflation, and it cannot come at a better time as well if we do see that, because the price is simply sitting right over the daily 10 SMA. Now, we only need to break over the daily 10 and the daily 21 SMAs to simply revert back to the upside and make higher highs and higher lows. But the daily 10 and daily 21 SMAs, let's take a look here, okay, are still declining, right, pretty rapidly as well, and in a very good angle to the downside. So that's the reason why I also mentioned that we could see a possible dip below the daily 200 SMA again as we head into the end of this year. But that can provide us with a great opportunity to possibly dip buy on tip here and potentially head into, as we head into next year as well. And we can hold this into next year, which is the most important part about tip, because you do not want to be day trading this or even swing trading this. You might want to have this as a position trade where we potentially hold this position for maybe 6 months or 3 months or 4 months, right? Depending on how the inflation reports come in as we head into the end of this year and into next fiscal year. All right. Now, let's take a look at the 10-year Treasury note yield. Okay, so this is a bit concerning as well, right? The yields continue to stay at the current highs, right, that we made back in around, I would say, well, 2 weeks ago, and 3 weeks ago as well, on the very first trading week of November. Now, why is this concerning? Well, first of all, rather than seeing a sharp decline in the yields here, for example, you can still see this on the 30-year Treasury bond yield as well, okay? We're just seeing the very weird, I would say it's weird, strength in the yields as the overall equity markets continue to move upwards with very good relative strength. And so this could possibly mean that we could be seeing a potential correctional move early into next year, which could also align with the seasonal trends of overall relative weakness into the end of January and into the beginning of February of next year. And so maybe these bond yields and treasury note yields are potentially hinting at a fact that we're about to see a potential blow off the top move on the overall equity markets, and we could be seeing a technical correction in the overall markets of about 10 to 15%. Now, I'm going to delve and expand more into what that could possibly mean in next week's CFO Swinger Watch report and in the overall technical analysis video as well. So make sure you guys are on the lookout for that. Okay, so that's kind of what I'm seeing from bond yields. It's kind of an early warning sign here. And also, on top of this bond yield rise, we're also seeing the dollar having a dominant upside price trend, right? And we made a new higher high and a higher high pivot point compared to the previous pivot high point that we saw on this specific day here that's outlined with this yellow arrow. So back in October 3rd of last year. And so that is also slightly concerning, but obviously more concerning for commodities since usually when we do see a strong dollar, we tend to see commodity prices being more pressured to the downside. And that's what we've been seeing so far. And so with this dollar raging to the upside, that is also a potential risk for any equity in the equity markets, especially when you have a long-term perspective to the upside as we head into next fiscal year. All right. So with all that in mind, let's take a look at a specific sector, a few specific sectors as we head into next year. So first of all, let's take a look at XLF, the financial sector, or the Spider Select Sector Fund for the financial sector. So obviously, the financial sector has been huge on moving to the upside because last week we continued to make higher highs and higher lows with rapid vertical uptrends with an amazing volume as well, right? So this entire price trend has been making literally an exponential move to the upside. It just looks vertical, right? I mean, just from the curvature, right? We're seeing just a vertical uptrend. I mean, this is, I don't know how else to describe this, but this is a very, very good uptrend, right? I really have no words for this. And so when we tend to see an overall uptrend, a very, very strong uptrend at that in the overall financial sector, that usually indicates that we're still seeing a very strong underlying bull market. Right? Because during a bull market, we tend to see the bullish sentiment basically visiting every single sector in the overall market. And we tend to see a very strong underlying bull market when the specific financial sector tends to see a very good uptrend and very good bullish relative strength and momentum. And so for XLF, as we head into the end of this year, this could potentially be pointing towards that possible blow off the top moment for the overall markets as long as we continue to see this amazing strength coming out of this financial sector. All right, so I want you guys to continue to watch out for XLF because if we see XLF seeing any type of a weakness or potentially a spinning top candlestick forming or any type of bearish, gravestone doji candlestick or even an evening star doji candlestick on the daily time frame, that could be your early other warning sign that we could be seeing a potential correction as we head into next year, or potentially just a simple rotation out of financials and possibly into the many other sectors that we have, which is also now a good segue to look into XLE. Okay, so this is the Energy Select Sector, right? The Spider Select Sector Fund for the energy sector. So for the past 3 weeks, we have been seeing the overall energy sector making consistent higher highs and higher lows, looking very, very similar to XLF with this crazy uptrend and relative strength to the upside. And what's amazing about XLE is that compared to XLF, it didn't really consolidate after that euphoric rise up higher and gap up on November 6th. Instead, it continued to make higher highs and higher lows without resting at all from any of the previous resistance levels like at 93.50 or even at 94.50 right over here. And it just continued to trudge up higher, making higher highs and higher lows. Now it has not made a new previous pivot high point that is indicated by this yellow here on April 12th of $98.97, but I wouldn't be surprised if XLE is able to retest that previous pivot high point and overtake it this short trading week, just because of the fact that we have such great momentum and great volume coming out of this XLE energy sector. Now, this also harkens back to the possibility of inflation potentially popping up back up higher into next year. Because when we see energy prices, well, the overall energy sector moving back to the upside, that could be possibly indicating that inflation may be back on the rise, and we might have to refocus our attention to bonds like TIP, right? The TIPS bond ETF. Okay, so you can use XLE as another indication that there could be another pop in inflation and possibly could affect the overall equity markets. Because again, if inflation goes back up higher, the Federal Reserve may or may not have to bring back pauses during their current rate cut cycle, and that could potentially waver their current confidence that they have with the underlying economy and with their dual mandate of keeping a low inflation environment and a very, very good solid labor market. Okay, and so I talk all about this in the CFO Swinger Watch report from 2 weeks ago. So as a final reminder, make sure you guys read that report and make sure you guys remind yourself what I've said during that masterclass for inflation. Okay, so that is it for this video. If this technical analysis video was insightful, make sure you guys leave a like down below. And if you aren't subscribed yet, make sure you guys hit that subscribe button. Now, if you guys are watching this video when it just became public and you want to watch this video a day earlier when it's private on Sunday, all you need to do is become a part of the many, many readers of the CFO Swinger Watch report and a private member of the private CFO Discord. You can get 50% off for your first 30 days. It's a first come, first serve basis. So all you need to do is DM me on Instagram at ChartsFocus1 to claim your spot. Again, just simply DM me on Instagram at ChartsFocus1 to claim your spot. Good luck, and I'll see you all tomorrow morning.